Hello, I'm Ryan Kelley, CIO at Hennessy Funds, and I'm here again to share some of our thoughts on the current market and investing. Currently, all major US indices are continuing to make all-time highs, and so far this year, the Dow is up about 11%, the S&P is up about 15%, and the Nasdaq is soaring over 19%. The resilience we've seen is pretty incredible, but also not necessarily out of the ordinary when we look at the long-term returns of the market. Since the end of the financial crisis in 2009, for instance, which is almost 17 years ago, the S&P 500 total return has been 17% annually, while the Dow has returned about 15% annually as well. So while this is certainly a very good year, it's not completely out of the ordinary. One thing that happens, though, is that along the way, we've also seen that there have been many downturns in the market as well. For instance, when you look at just the Dow, there have actually been 11 different corrections of over 10% since that financial crisis of 2009, with the two worst being a 37% drop in 2020 and a 22% drop in 2022. So how does this all relate to where we are now? Well, we're currently in the middle of a government shutdown. There's a lot of uncertainty as to how that will affect government employment, how it will affect spending, how it will affect investor confidence ultimately. Tariffs continue to increase inflation and create disruptions with our trading partners around the world. The Fed has started to cut rates with the expectation that it will cut another 4 before the end of 2026. And we have strong GDP growth in this environment as well. It's driven by a resilient consumer, but unemployment data has not necessarily been the brightest spot, as we've seen a lot of downward revisions and somewhat anemic growth. And we're also sitting here with historically pretty expensive valuations across many different major industries, although there are some very big discrepancies between different sectors. For instance, the S&P technology sector is at about 38 times earnings, and we have the energy sector at only about 15 times earnings. So we're basically living in a market of dichotomies, and it's kind of hard to understand where we go next. With such high valuations and very good earnings growth expectations, we also have uncertainty as to how all of this government shutdown and tariffs and inflation will actually affect GDP going forward. We would continue to expect that there's going to be some market volatility as we do digest so many different disruptions. But one thing to note, and this is what one of our long-tenured PMs, Dave Ellison, reminds us, just because stocks are expensive, that doesn't actually mean that they're about to go down. Rather, there has to be some sort of a drastic change that would make the market change directions. It could be a larger macro sort of exogenous event of some kind. But right now, we don't really see that about to happen. Regardless, we like to remind investors to stay invested for the long term, stay invested in a balanced way. We like small and mid-cap stocks. We think that their relative valuations are pretty attractive. And we also like, in case there's some softness in the market, we think that certain of the more defensive sectors like utilities or staples might fare better than the rest. But overall, we want to remind investors to stay invested. Timing the market is very difficult. We prefer to use time-tested investment strategies, and we're always mindful of downside risk.